Get the full global macro and markets picture with Capital Economics' all-access packages. CE Essential gives you full access to all of our award-winning written analysis, all of our online briefings, and a host of critical data tools. And for deeper engagement with our economist team, our proprietary data, and seamless integration of that data into your workflow, CE Advance is our most complete solution. Go to capitaleconomics.com today to learn more about CE Essential and CE Advance.
It's Friday the 14th of November, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, is AI destroying opportunities for young job seekers? But first, the rain's falling in London. That means business as usual, and it means that Neil Shearing, Group Chief Economist, is with me once again to run through the big stories in global macro. Hi, Neil.
Hi, David.
US government back open for business. We've just seen a record 43-day shutdown. We've missed key jobs and inflation data in all that time. So when are we going to get the October numbers? Will the November reports come out on time? And what's this all going to show, do you think?
Yes, all big questions. And it's interesting, isn't it, how the reaction in markets, the response in markets has quickly shifted from a bit of relief around the shutdown ending to suddenly a flurry of questions about when will we get the data and what will this show about the US economy over the period of the shutdown. I think at this stage, it's fair to say we don't really know. We published a piece over the past few days looking at the potential timetable for data releases over the coming weeks. It's worth taking a look at that. Essentially, we could get the September payrolls numbers, which weren't released because of the shutdown. That could arrive relatively quickly. Anything for October that relies on administrative data, that is to say, data collected by the BLS via firms using records held at a firm level. So things like retail sales, industrial production, that could, I think, follow after. But anything that requires surveys of households, for example, or a firm. So think about particularly the CPI report. It requires people from the BLS going out into bricks and mortar stores, conducting a survey of prices. Clearly, those surveys did not take place in October because of the shutdown, and they're very difficult to then put together retrospectively. So I think markets should get used to the idea that it may just be the case that we don't get some data for October at all. So yeah, I think if you want a base case, I think a reasonable base case is we get the September payrolls relatively quickly. Anything thereafter for October that relies on administrative data, so things like retail sales, industrial production, stuff that's collected from the records of firms, data that's collected from the records of firms could follow. But anything that requires surveys in the field, I think we may just not get.
So we're not going to have a complete data set. I mean, we have talked before on this podcast, as the shutdown's been running on, about these alternative measures that the markets come to rely on with the government shutdown for some kind of read on what's happening with things like jobs. And what have those measures told us? Is there any indication of how labour markets have held up, how consumers have been holding up?
The proverbial mixed bag, I'm afraid to say. In the real economy, it looks like it's been business as usual, really. As we had anticipated, it does not look like the government shutdown has had a big impact on economic activity in the US, if you look at measures like the ISM, the PMIs, and so on. In contrast, if you look at measures from the labour market, there are some signs there that hiring is still slowing. If you look at the ADP, that's still pretty weak. And if you look at the challenger job layoff numbers, those spiked in October. However, that comes with the usual health warning that some of these private non-official sources of data are nowhere near as robust as the public official data. Now, I know the official data has its own set of problems, but if you think about the challenger job cut numbers, for example, this is essentially scraping company reports for announcements of job losses. Now, some of those job losses that were announced in October have either already happened or they're coming way into the future. So just because they're in those challenger job cut numbers does not necessarily mean that they all happened in October. Some of those have already happened. I would have been reflected in some of the official data. So activity holding up, some signs that the cracks might be opening it up in the labour market, but we'll take that with a big bucket of salt because it's coming from data that is not as robust as the official data, albeit the official data itself, clearly there's some question marks over the accuracy of too. So we're in a strange position where a lot of the data in the US and for that matter, other economies is not as robust as it once was. That's to say the official data. The private data is even less robust, but it's all we've got to go on. So some sympathy for Jay Powell and colleagues. They really are in the fog, as he says.
Yeah, and that shift in expectations for the Fed meeting in December, decision due December 10th, there had been only a few weeks ago, I mean, the pricing had suggested that for the most part, we were going to get another rate cut. That shifted over the past few days. Is that because, with these uncertainties around what the data is showing as you've described, the Fed might just think, let's just hold off until we get a clearer view, until the fog clears, to extend the analogy? Or is it a sense that with inflation where it is, we're not confident that we need another rate cut at this point?
I think there's a couple of the market reaction, I think, has been in response to a couple of things. Clearly, the trigger for this was Powell's remarks immediately after the FOMC meeting in October. The decision then, of course, to cut interest rates. But I think there was a sense in which, in order to get that cut agreed and to keep some kind of unity on the FOMC, he then had to go out and deliver a press conference that damped down expectations of further rate cuts well into the future. So I think there's clear evidence that there are cracks emerging within the FOMC. And there's that Wall Street Journal story earlier this week about how there's a growing band of FOMC members that are more skeptical about the need for future interest rate cuts. Now, I think there's a slight danger here that we get ourselves too caught up in the debate over will they cut in December, won't they cut in December. I think that's frankly a coin flip at this stage. Now, clearly, there are some clients for whom that decision will matter enormously because they've taken positions on it. But I would argue that the much bigger point here and the biggest shift that we've seen in the market over the past month or so really is one that we've talked about before, which is that I don't think that the Fed is going to be cutting interest rates over the next 12 months quite as aggressively as the market was pricing in, say, in September, early October. Back then, we had 4 rate cuts priced into the market. In 2026, we're now down to, I think, about 3 more. So the market's taken out a rate cut over the next 12 months. At the time of speaking, we've only got 2 25 basis point cuts in our forecast, and that's been a forecast for a while. Two 25 basis point cuts, that is, over the next 12 months or so. So I think there's a slight danger here. We get fixated on the December outcome of the FOMC. Really, the big story is that the Fed, I don't think, will be cutting quite as far or as fast as the markets had been anticipating. And we've started to see some of that be reflected in market pricing over the past couple of weeks.
Okay, I want to go back to that shutdown because it's one of a number of news stories we've had over the past few days. As I say, the shutdown agreement to fund the government through January. Then in France, Sébastien Lecornu's government, they agreed to delay pension reform, avoid another government collapse. And then here in the UK, I am loath to talk about UK party politics because we've got listeners in Brazil and in China, all around the world. Shout out to those listeners, but I'm sure they don't want to hear about the dysfunctions of this government.
We've really got 10 minutes as well.
And it has been a crazy few days, hasn't it? And the headlines are still coming in. But what ties all of these stories together is this question of public debt. Is government struggling to deliver standards of living that voters had become accustomed to? And these struggles aren't going to go away. In fact, probably the opposite. I know it's that time of year when you and the team are putting together what you think are going to be the dominant themes for the coming year. So what's going to drive macro in 2026? What's going to drive markets? These political, these economic, financial instabilities that are caused by public debt, they've got to be up there on that list, right?
Exactly. One of the key themes that we had in our forecast for 2025 was that we would have recurring wobbles in bond markets over the fiscal outlook. And indeed, that's what we've seen. We've seen it in the UK over the past week. We've seen it in France. We even saw it in the US, didn't we, earlier this year, concerns about the fiscal outlook. So I don't think that's going away. And it's not going away for the reasons that you suggest. One is that governments across the developed world appear incapable of pushing through even moderate measures to tighten fiscal policy, to get budget deficits down, to get debt onto a more sustainable path. We're seeing that play out in the UK at the moment, but we've seen it too in France. Now we're now into our fourth government in the past year. Credit to the UK, at least there's a debate about the need to get the budget deficit down and get public debt stabilized as a share of government GDP. In France, there's a debate, but there's absolutely no sense of a government being able to do anything about it. And in the US, there's not even a debate about it. Right? They're just passing budgets that essentially entrench a budget deficit of 6% of GDP ad infinitum. So the UK feels like a basket case, but at least the government's trying to do something to rein in that budget deficit. But to answer your question, the first part, the challenge is that the governments are either struggling to articulate policies that they'll pursue to narrow the budget deficit, or then having set those out, struggling to actually enact them. Underpinning all of this, though, is that governments everywhere have struggled to really formulate a coherent strategy for economic growth. And that's not just true of current governments. It's been true of governments, I think, across the advanced world, across the developed world, since the global financial crisis. We know a number of the challenges. In Europe, they were really well articulated in the Draghi report, for example. In the UK, we've talked for years about low investment rates being a problem and planning restrictions being a problem and the need for some kind of welfare reform and labour market reform. But no government in any major advanced economy has been able to draw up a coherent and comprehensive strategy for economic growth. And that's what's missing. Without that, I don't think we can hope to get fiscal positions on a sustainable footing.
I mean, it's one of the answers to that. Also, one of the answers we've articulated to these growth problems in developed market economies is artificial intelligence. That AI is going to bring productivity benefits that will, over the long term, will raise growth rates across these economies. We talked on the podcast recently about how all of this investment in building out AI seems to be having some impact on US growth rates at the moment. But there is still a disconnect there, isn't there, between what the macro data is showing and the sort of the hundreds of billions of dollars in capex that these big tech firms, these hyperscalers, have been telling their investors about, the stories they've been telling. I know this might be your most frequently asked question of late, and it ties in with what I'm just asking about the sort of the fiscal hole that these governments in and their inability to articulate how to get out of them. But are we going to see a real economic payoff from all of this investment in computing power? Where are we going to see it? And when are we going to see it?
Goodness me, lots to unpack. Yeah, lots to unpack there.
40 seconds or less.
Yeah, exactly. 40 seconds or less. The first point to say is that I think we probably will see a payoff in the real economy, yes, but it's going to come a bit later than perhaps some of the optimists expect. When it does arrive, I think it will arrive in the US before it arrives in other advanced economies. And this is an example of economic growth picking up and some reinvigoration of economic growth in spite of rather than because of government policy. So this would not be a pickup in economic growth because a government has generated and drawn up a comprehensive economic strategy for economic growth, followed that through. It would be from heaven instead in the parlance. But just on the narrow question of capex intentions, because you're right, this is a question that now comes up with increasing frequency in client meetings. There's a slight danger here, I think, of muddled thinking and, if I dare say, comparing apples and pears when it comes to the data. When we look at, for example, company earnings reports and the enormous sums that are contained within those with regards to future investment intentions by the hyperscalers, these big tech firms, those are all data that are an investment intentions in nominal terms, in current price terms, and the sums are indeed enormous. And the critical question for those companies is, can they generate a stream of revenue that justifies that expenditure, that capital expenditure? And I think in some cases they'll be able to, and in other cases, history shows us that there's frequently overinvestment around these kind of new breakthrough general purpose technologies, and some of that investment will inevitably be wasted. Investors will bear losses, and that will work through over a period of many years. That's how the markets need to be thinking about these enormous capex plans as they relate to the hyperscalers themselves. It's all about nominal investment and whether you get a nominal stream of revenue that justifies that investment. When it comes to the real economy, however, we need to think in real terms. That is to say, investment adjusted for prices. And the reason we need to do that is because it's real investment that determines how much productive capacity is actually being added to an economy. So there's a slight danger here of apples and pears. You get these kind of enormous capex plans of the hyperscalers reported in nominal terms. They look enormous. It's the real investment that matters for the real economy. And it's not just in those hyperscalers. We know that from past general purpose technologies, it's the second round of investment in adjacent sectors that really matters in terms of driving that rollout. And what's more, it tends to be the case that you need some overinvestment initially to increase the supply of this new technology, bring down its price, encourage its rollout and diffusion, and therefore spread through the economy and deliver the productivity benefits that general purpose technologies tend to deliver. In other words, what may look like a waste from a financial standpoint of the hyperscalers, and indeed may be a waste too, that there could be some consequences for investors there. Actually, it's an important part of the diffusion process, this overinvestment, bringing down prices, diffusing the technology, getting it out there. Lots of different numbers floating around, but I think, yes, some of those investment numbers for the hyperscalers are enormous. They may well not be justified. History would suggest that there will be some losses. Some of these firms will not see adequate returns on those investments. However, from the perspective of the real economy, overinvestment is sometimes a necessary part of diffusions of new technology. It increases the supply of that technology. It gets the price down. It encourages the spread of the technology through the economy. And therefore, in doing so, that's how you get the productivity gains.
So that's you lay $500 billion worth of fiber optic cable, end of the 90s, coming into the 2000s.
Exactly. Yeah, or think about railways in the late 19th century. Massive investment, and in some cases overinvestment, but it left in place an infrastructure that when some of the railway companies went bust, the infrastructure was still there. And the same is true with the fiber optic cables more recently, right? You had massive overinvestment. A lot of that was latent capacity for a long time. Some of those companies went bust, but it left in place infrastructure that was useful. And of course, we're now using today, and it's an important part of the productivity uplift that we got from the dot-com period and the computer and internet revolution. So I suspect AI will be the same. We get this overinvestment in some areas of AI. Some firms make big investment bets that don't pay off. That delivers a loss to investors, but it leaves in place an infrastructure that ultimately is still useful and ultimately still underpins productivity gains. And getting back to your question about economic growth, it's another reason to think that the real boost to economic growth will tend to come later in this decade. We're starting to see some pickup in productivity growth in the US, potentially related to AI. I suspect AI is playing some role in that, but it's by no means the only driver or indeed the most important one. I think the big benefits from AI are going to come later in this decade.
But just coming back to this fiscal question, it's going to bring some relief, perhaps, the growth that comes from the diffusion of AI. But it's not, for example, going to solve a housing shortage in the UK. It's not, for example, going to settle the question of whether French workers can continue to retire at 62 versus 64, right?
Interestingly, on the retirement question, maybe it might do, because if we do get a big productivity uplift from AI, then the consequence of that might be that we all decide that we don't need to work 5 days a week, or we don't need to work into our 70s because suddenly the workforce has become more productive. But I think the most important point to say is it's not going to settle that question this year or next year, or maybe even the year after. So if you're a government operating in the here and now with a set of forecasts, in the case of the UK, being provided to you by the OBR and a fiscal target to hit, then AI is not going to come to the rescue for this budget for the UK government. And it's not going to mean that the government in France is not going to have to force through some kind of fiscal adjustment over the next 12 months or so to keep the budget deficit on track and the bond markets on side, because these changes and shifts play out over a longer time horizon. So it might mean that some of the demographic challenge is eased because workers become much more productive and that becomes part of the solution. But we're not going to know whether that's the case anytime soon. This is a multi-year process.
Neil Shearing on AI, fiscal risks, and the impact of the end of the US shutdown. We didn't have time to get into the latest China activity data that was out earlier today. It showed another massive fall in fixed asset investment in the year through October. It's a continuation of a theme we saw really starting in the third quarter, and there is lots of talk about the government's anti-involution campaign that's aimed at these painful price wars that are really fueling deflationary pressure in China. Our China team thinks that weather-related disruptions may have been playing a part in all of this weakness in investment, and therefore that it is going to rebound soon. I'll add their analysis from a few weeks back to the podcast notes because clients have been asking about this issue a lot, and I think it's an argument that isn't getting enough broader airtime. On AI, I will add some recent analysis the team has done to the podcast notes as well. As we discussed, this issue around how exactly it's boosting economies is probably the most frequently asked question we've been getting from clients of late. I will add some other pieces to the podcast notes from the last week that clients have been reading most, including things like why we think gilts won't underperform for much longer, and some analysis on the macroeconomic impact of rising defense spending among emerging markets. I also want to flag 3 drop-ins this coming week. These are our short-form online briefings. We've got one on Egypt's recovery, one on the outlook for commodities markets, and a drop-in all about what to expect from that UK budget that's happening the following week. That last drop-in is happening Wednesday, 10 a.m. New York, 3 o'clock London. I will link to our events page where you can sign up for all of these sessions. And remember, if you're a CE Essential or CE Advanced client, you get access to all of our online and in-person events, all of our written analysis, and a large and growing suite of data tools. If you're not already a subscriber, well, why not? Contact us at sales@capitaleconomics.com and we will get you set up. That's sales@capitaleconomics.com. Now, back on AI. One of the big stories doing the rounds at the moment is how this technology means that companies need far fewer entry-level positions because why hire a graduate when AI can do the basic tasks that a human can do? If the headlines are right, this is a crisis for an entire generation of young job seekers and for policymakers. But do the facts fit the story? Vicky Redwood, our senior economic advisor, has been looking into the issue and she's just published an in-depth analysis that separates the fact from the fiction. I spoke to her earlier this week and I started by asking her whether what we're seeing in the jobs market is the result of the rollout of AI.
Well, we have started to see a few worrying signs. I think a lot of attention has focused in recent weeks on the pickup in the recent graduate unemployment rate relative to the unemployment rate of all workers, or indeed all young workers in the US. Alongside that, we've seen a rise in youth unemployment in several countries relative to the overall unemployment rate. And that's been particularly marked in some countries, including France, UK, Canada. And then also hitting the headlines have been when job listing sites or job search engines have announced that there's been big drops in the listings and the vacancies for entry-level jobs and graduate jobs in particular. Now, we have to take some of these with a little bit of a pinch of salt. So, for example, you might see media stories of massive falls of the sort of 30 or 40% annual drop in graduate vacancies or entry-level vacancies. Often they neglect to mention that the overall jobs market, the overall level of jobs vacancies has fallen sharply as well. So some of these headlines can be a bit misleading. But I think, generally speaking, it is fair to say that we've got quite a lot of evidence now that the jobs market for entry-level jobs and graduate jobs in particular has weakened quite sharply over the last year or two in the US, but also in other countries as well.
So some evidence, but maybe not enough evidence. Where are we seeing some clear signs that AI is hurting openings at this level of the job market?
Well, I think the main question now is, to what extent is AI responsible for this? So I think there is fairly conclusive evidence of a relatively sharp slowdown in the more junior end of the labour market. And a lot of people are saying, well, that must be down to AI because it's evidence that employers are increasingly using AI to carry out these tasks that are traditionally assigned to more junior members of the workforce. And certainly AI can be used to do a lot of this stuff, be it drafting presentations, primary data analysis, basic coding, all that sort of thing. But I think we need to be careful not to put 2 and 2 together and get 5, because there's some aspects of this explanation that don't quite add up. So to give you some examples, for a start, there's question marks over the timing of all this. So AI really began to take off towards the end of 2022 when ChatGPT became widely available. But some of these metrics of labour market deterioration actually started before then. And in fact, the gap between the unemployment rate of all people versus recent graduates in the US, for example, that's been deteriorating for about 10, 15 years. So that's not obviously an AI thing. And then if we look at the country level of recent developments, you'd expect labour market conditions to have worsened most for entry-level workers in the US, given that AI rollout and development is faster there. But in fact, some of the countries outside the US that have seen the worst labour market developments. And then if we look at the sectoral evidence of this, the occupational evidence, there are plenty of studies suggesting that job prospects have worsened most in sectors that are most vulnerable to AI. And they're the ones that tend to get the most attention. But there are also a lot of studies that show there's no disproportionate impact on the most AI-exposed sectors. So I think when you sort of add all that together, yes, AI surely is having some impact on this part of the jobs market. And it certainly is having an impact in specific occupations, like, for example, computer software programmers. But to say that AI is wholly to blame for all of this, I think is wrong. And I think AI is a part, but not the main part of this story.
So if it's not AI, I guess the question is, why are we seeing weakness at that end of the jobs market? The fact that you've got unemployment rates rising in that demographic, it is concerning nonetheless. So what's causing it and how worrying is it? How much will these rates rise from where they are?
Well, I think there are some potential other explanations. One is just the general loosening of labour markets that we've seen over the last year or two. And inexperienced workers are often the first to suffer during a general hiring slowdown because they're basically easiest for firms to do without. And that loosening of labour markets itself reflects a variety of factors, including rising input costs, heightened uncertainty about demand in the face of tariff threats, that sort of thing. Other factors that could be playing a role, I'm thinking in the IT sector in particular, this could partly be a correction of the hiring boom that followed the pandemic. And that's come at the same time as there's been a rise in the number of computer science graduates, which has worsened that demand-supply imbalance. And I think if we're looking at the graduate market, jobs market in particular, there's some structural factors having an effect there. So maybe the pandemic is still having an impact, given that many graduates from the pandemic era missed out on work experience, making them less attractive to hire. Perhaps so-called degree inflation has also reduced the appeal of graduates to employers, namely the sort of the sharp rise in the number of graduates we've seen over recent years, including those achieving high grades. So I think there's some factors that are probably affecting the jobs market alongside AI.
Is it the case that when, you talked about the loosening of jobs markets after, that burst of pandemic hiring, is it a case that when labour markets loosen, you see the more vulnerable ends of the labour market, the entry-level positions, being affected first, and that actually what we're seeing is just a broader loosening of labour markets that could lead to something more worrying?
So yeah, I think it is generally partly a broader loosening of labour markets. Whether that then indicates that we're going to see a bigger deterioration in labour markets is not necessarily the case. I think that depends then on the wider economic environment, obviously. And we think the global economy is holding up relatively well. It will continue to hold up quite well. So we don't see these recent developments as being the sort of early warning signs of a much bigger and wider rise in unemployment. So from that point of view, we're relatively sanguine.
All right, just back on AI. We've spoken a couple of times, haven't we, about about AI and labour markets. Each time you said you weren't too worried about a massive negative impact. Are you still not too worried based on what we've been seeing?
Yeah, I think that's fair to say. I mean, we've obviously got to acknowledge the huge uncertainties here. I mean, we don't even know how the AI technology is going to evolve over the next few years, let alone be sure about what the effects of the technology that's been developed so far will be. But as we've spoken about before, David, if we look back at big technological developments and steps forward in the past, over the long run, there's been no obvious adverse effect on employment, because any job losses or displacement effects we've seen have tended to be offset by the positive effects of the technology on employment. And so far, I don't think we've seen anything to suggest things will be different this time. I mean, it could be different, but so far I'd say there's been nothing to change my mind on that. And I think, yes, maybe we're starting to see some of the negative effects of AI on the jobs market come through, as I said, in sort of specific occupations like, software programming, or selected parts of professional services sectors. But if we look at surveys of what firms are saying, they're generally saying, yes, we might slow hiring a bit in response to AI, but actually a far bigger proportion of firms are planning to either hire staff with new skills or upskill existing staff to help them adapt to these new technologies. And I think that's still the biggest story going forward, that AI is generally going to complement existing workers to a greater extent than just automating their work and making them redundant.
Yeah, you can imagine a sort of snapping back as well, can't you? To the extent that any companies have cut payrolls because they say, well, AI can fill that role. As you say, we're still trying to, we're still figuring our way in terms of how this technology is evolving and how this technology can help. And you can see a world in which companies some way down the road go, well, actually, we did cut our payrolls. We did think that AI could replace them. It turns out that actually it didn't fulfill its promise, or you still need humans to work with AI to get the most efficiencies out of it. And then you kind of see this snapping back, and actually they have to rehire or grow their payrolls in response, right?
Yeah, exactly. And that's why one important thing to look at is what's happening to productivity growth, obviously. I mean, if we were at the point where firms were finding that they could replace a lot of workers or workers' tasks with AI, and therefore could get rid of those workers, then we would expect to be seeing those productivity gains coming through. But we have seen a pickup in productivity growth in the US, although that might be for other reasons, such as firms seeking efficiency savings to offset rising tariff costs. But outside of the US, we've still not seen really any discernible pickup in productivity growth coming through. And sort of more generally, we're not the process of AI rollout across the economy and firms actually using this in their day-to-day workplaces, that process is still very gradual. Yes, we all see headlines every day about the huge capex expenditure by the hyperscalers and all the money being invested into the big AI infrastructure. But then there's a sort of big step from that to, on a very granular level, all the individual companies of the economy using AI very effectively and getting big productivity gains out of it. Again, so far, I haven't seen anything that persuades me that process is suddenly picking up very quickly. But that is one of the key things to watch over the coming months and years, to see how quickly that rollout is happening, and therefore how big any sort of transition and temporary labour disruption effects might be.
Let me ask you, I mean, the very extreme view here, and actually I'll frame it by quoting a researcher from DeepSeek, which is one of China's AI large language model leaders, quoted at a conference earlier this week, said, humans will be completely freed from work in the end. Now, he's not the first to predict an end to work entirely. In fairness to him, he also went on to say, actually, this isn't a good thing, that governments will need to step up. But what if we're wrong? And what if actually we are on a path that leads to the end of work for humans? I mean, on one hand, you think, yeah, we'll all be lying in clover. On the other hand, it's a pretty bleak prognosis, isn't it?
Yeah, well, it's possible. So obviously it's not our central forecast. It's possible if it turns out that AI can automate work across the whole economy, basically. And in this scenario, you end up with very few sectors where humans still have the comparative advantage. So in this world, AI automates everything from nursing to social care, hairdressing, all those elements that you think there would still be a bit of a human touch in. And then there's just not really any sectors of the economy left for people to work in. Now, the upside of this scenario is that if AI is this amazing and efficient, then that's great. The owners of the AI will become a lot richer. That should diffuse across the economy. We won't have to work as much, but we'll still have a high standard of living. There's a couple of problems, though, in this scenario. One is, how evenly will those gains be distributed? Maybe they'll just be very concentrated, and then you will get a big rise in inequality in the economy. And secondly, we get into bigger picture questions now about, a world without work. How will society function? How will people function in a world where they don't actually really have to work anymore? So I think we're getting out of the realms of macroeconomics there. But yes, it's interesting to think through those sort of more extreme scenarios.
And at the other extreme, what if AI does turn out to be a damp squib? What if it turns out not to fulfill the pretty big promises that have been made about it?
Well, then obviously we won't get the productivity gains we're hoping for in the wider economy. And that will be pretty disappointing, given we're kind of putting our hopes on AI to bring an end to the last decade or two of pretty poor productivity growth in developed markets. And so that would have big implications for standards of living, also for fiscal situations, because it would then make the outlook for fiscal trajectories look worse. It would also, from a nearer term point of view, mean that all this money that's being invested into AI would turn out to be pretty pointless. And so that would bring about bigger risks to stock markets and equity prices of these big tech firms in the near term, as that proved to have been investment that was not worthwhile.
That was Vicky Redwood on AI and the jobs market. We've got a whole body of work on the macro and market implications of this technology that I will link to in the podcast notes. I want to leave you this week with an exclusive clip from our recent India drop-in, and in particular to two questions. One about whether India's reserves of rare earths are an answer to Chinese dominance, and the other, back on AI, whether this technology is a threat or an opportunity for the Indian economy. You'll hear Chief Asia economist Mark Williams talking to Shilan Shah, our Deputy Chief EM economist. I'll put the full recording in the podcast notes. We will be back next week with more from the world of macro and markets. But here's Shilan now talking about India's rare earth reserves.
Yeah, so India's got the third largest reserves of rare earths in the world, behind only China and Brazil. So, in the context of economies and firms wanting to add more resilience to supply chains, it's natural, I think, that India is now being talked about as an alternative to supplier to China for the global market. But the reality really is that production in India is very small. It contributes, I think it was under 2% to global production, despite holding nearly 10% of global reserves. Several reasons for this. I really enjoyed looking into this, actually. It became a sort of pseudo-geologist for a while. But essentially, one of the reasons is that the type of sand that the rare earths are found in India contain another element, thorium, which is radioactive. So there's some very tight regulation around mining rare earths in India specifically. On top of that, it doesn't have any midstream processing capacity. So it just hasn't been able to build out that industry. And more generally, just regulatory bottlenecks have prevented lots of investment into India's rare earths industry. Now, some of these hurdles could be cleared, but we just think it's going to take a very long time to do that. So the aim for India's government at the moment is to increase its own self-sufficiency rather than become a big sort of global player. It's not going to do much necessarily to boost its geopolitical clout, but if India is able to become a bit more self-sufficient in rare earths, then of course then that eases a sort of potential choke point for its manufacturing sector if China were to tighten exports again.
Great. So AI, what's India's situation in a world in which AI is spreading rapidly? Is it more of an opportunity for India, or is it more of a challenge? I think the question here is in the context particularly of the large services exports that we get from India. Shilan, do you want to take that?
Yeah, been very topical. India, I think the first thing to say, it is pretty unique amongst emerging economies, certainly because of its large services sector, outsourcing sector in particular. That's pretty ripe for disruption from AI. Lots of jobs in the sector tend to be quite formulaic, repetitive, but it's also a very data-heavy field. So there's potential benefits from adopting AI as well. Now, I think the reason this has been very topical recently is that there's been a number of IT firms in India that have announced redundancies over the past couple of months. Tata, which is India's second largest corporate, said that it's going to reduce headcount by 12,000. We've had other IT firms such as Wipro announce redundancies as well. And that's all been linked to advancements in AI. So in that sense, it is presenting a threat to what has, over the past sort of 20, 25 years, been a real success story for India. But I do also think that some of the talk around a total collapse of that outsourcing sector does look a bit overdone. I mentioned that it's a data-rich field, so it is actually well positioned to take advantage of AI capabilities. So what you might end up with is fewer workers in the sector, but workers that are more productive as well. So it could still continue to contribute very strongly to India's overall economic growth. And for many of the workers that are displaced, I think the first point to make is that as a share of total employment, it's still very small, which underpins this idea that it's a productive sector of the economy. But for ones that are displaced, there are opportunities to upskill and reskill. This is something that the government has been very keen to promote, setting up task forces in order to address this. And I do also think that sometimes the discussion around AI in India is limited to only talking about the outsourcing sector, whereas actually when we think about some of the applications of AI from a broader perspective in things like healthcare, things like education, and we know that there are examples of AI being adopted in these fields, then actually India, which has a large sort of development gap in these areas, could really start to benefit, and that could help to boost human capital. I mean, some of the examples I'm thinking of in education, for example, helping in translation, helping in grading, lesson planning. These are just fairly basic examples, fairly easy applications of AI. But it really could revolutionize healthcare, education, as well as other fields as well. Yeah, I think it's a little bit too much of a narrow view to only focus on the outsourcing sector. We've got to think about the sort of broader perspective as well. And in that sense, the economic hit could be offset, I think. But yeah, this is something that plays out over a number of years, one to keep an eye on.
Great, thank you. I think in general, it's easier to sort of spot areas where AI can substitute for human capabilities and maybe a bit harder to anticipate the areas that it can complement them.